Are you ready to turn a housing crash into your biggest financial opportunity? In this video, we'll reveal the secrets to making killer investments during a real estate downturn. From the Airbnb market collapse to corporations like Zillow and Opendoor offloading properties, and the hidden shadow inventory banks don't want you to know about. We're covering it all. Plus, we'll dive into the surprising surge of pocket listings happening outside the MLS system. Stay tuned to learn how you can navigate these market shifts and come out on top. Don't miss out on these insider tips that could change your investment game forever. The world is in constant flux. What was true yesterday might be obsolete today. Remember 2008? The crash was devastating. People lost homes, jobs, and their life savings. Today, we face a different world scarred by a global pandemic. The aftershocks are still being felt. Some say we're headed for a recession. The real estate market is undergoing a major shift. The boom times of the pandemic are over. We're seeing a correction. This means opportunity. The same forces that create fear also create opportunities. Knowledge is your best defense. Educate yourself and position to profit from changes. Real estate has always been cyclical. It goes up, it goes down. It's like a roller coaster ride. The trick is not to get thrown off during the dips and turns. Right now, the roller coaster's heading downhill. People are nervous, they're selling, they're scared. But remember, savvy investors see opportunity in chaos. They understand that what goes down must come up. And they know that the biggest profits are often made during the most uncertain times. This is not the time to panic. This is the time to get smart. This is the time to learn the rules of the game, to understand the forces at play, and to position yourself to win. This is the time to become an educated investor. Don't be the person who buys high and sells low. Be the one who buys low and sells high. Be the one who understands the market and knows how to profit from it regardless of the direction it's heading. The media thrives on fear. They want you to believe that the sky is falling. They'll bombard you with stories of foreclosures, bankruptcies, and economic doom. But don't be fooled by the smoke and mirrors. The truth is, there are always opportunities in real estate, even in a downturn. In fact, some of the best deals can be found when the market is soft, but you need to know where to look and what to look for. You need to see through the hype and understand the reality. This is where knowledge becomes power. By understanding the forces that drive the real estate market, you can identify opportunities that others miss. You can learn to profit from the fear and uncertainty that paralyze others. Remember, the real estate market is like a giant ocean. On the surface, it may seem chaotic and unpredictable, but beneath the waves, there are powerful currents and patterns that dictate its movements. Your job is to learn to navigate those currents and use them to your advantage. Yes, the market is changing. Yes, there are challenges ahead, but with challenge comes opportunity. This is the time for bold action, for strategic thinking, and for informed decision making. This is not the time to bury your head in the sand. This is the time to educate yourself, to understand the market, and to position yourself to profit from the coming changes. The information you're about to receive is not just about buying and selling houses. It's about understanding the financial system, the forces that drive the economy, and the strategies that successful investors use to build wealth. This is about taking control of your financial destiny. It's about securing your future and building a legacy of wealth for yourself and your family. It's about mastering the crash and emerging stronger on the other side. Remember the Airbnb gold rush? During the pandemic, it seemed like everyone with a spare room and a Wi-Fi connection was becoming a hotelier. Low interest rates and a desire for flexible living spaces fueled an explosion in short-term rental investments. People were cashing in, riding the wave of travel demand and remote work. Cities became flooded with Airbnb listings, each one promising a unique and personalized experience. It seemed like the party would never end. But as with all good things, the party eventually started to wind down. Travel patterns shifted, workers returned to offices, and the economy began to sputter. The once lucrative Airbnb market started to show signs of strain. What was once a goldmine for some became a financial burden for others. Many Airbnb investors, once riding high on occupancy rates and premium pricing, were now facing a different reality. The after-party blues had set in. The shift was palpable. Properties that were once booked solid started to experience vacancies. The competition intensified as more and more Airbnb listings flooded the market. Suddenly, those once reliable rental incomes began to dwindle. What was once a steady stream of passive income was now an unpredictable trickle, leaving many investors scrambling to cover mortgages and expenses. The allure of quick returns and entrepreneurial freedom that had drawn so many to the Airbnb market was fading. In its place was the cold reality of market forces, competition, and the cyclical nature of real estate. For those who had overleveraged themselves, banking on consistently high occupancy rates and inflated property values, the situation became dire. The dream of financial freedom through short-term rentals was turning into a financial nightmare. The Airbnb boom was a classic example of the allure and the aftermath of speculative investment. Fueled by low interest rates, easy access to credit, and the promise of quick returns, investors flocked to the short-term rental market. But many failed to consider the long-term implications, the cyclical nature of the travel industry, or the potential for market saturation. They were seduced by the siren song of passive income and the perceived simplicity of the business model. The reality, as many are now discovering, is that short-term rentals are a business like any other. They require careful planning, market analysis, and a deep understanding of the local tourism landscape. The current situation in the Airbnb market serves as a stark reminder that real estate investment in any form is not a get-rich-quick scheme. It requires diligence, patience, and a willingness to adapt to changing market conditions. Today, the Airbnb market is awash in listings. From cozy studios to sprawling villas, the options seem endless. But this abundance of choice comes at a cost. The increased competition has driven down prices, squeezing profit margins for even the most seasoned Airbnb operators. The days of setting high nightly rates and enjoying near perfect occupancy are over, at least for the foreseeable future. Airbnb owners are now facing a new reality: the need to compete on price, amenities, and guest experience to attract bookings. This shift in market dynamics has created a wave of uncertainty for Airbnb investors. Some are choosing to weather the storm, hoping for a rebound in travel demand and a return to pre-pandemic profitability. Others, however, are opting for a different strategy. Faced with mounting expenses, dwindling returns, and the specter of further market decline, many Airbnb owners are deciding to cut their losses and sell their properties. The Airbnb phenomenon wasn't the only force reshaping the real estate landscape. Enter the tech titans companies like Opendoor, Zillow, and OfferPad. These companies, flush with venture capital, embarked on a buying spree. Their business model was simple use technology to streamline the home buying and selling process. But was this model sustainable? Or was it a house of cards built on cheap credit and inflated expectations? These tech-driven real estate companies, armed with algorithms designed to assess property values and predict market trends, believed they had cracked the code to real estate success. They wagered that their technology could outmaneuver the complexities of a market, often driven by human emotion, local nuances, and unpredictable economic factors. They bought properties at scale, often sight unseen, relying on their data-driven models to guide their investment decisions. They aimed to profit from the spread between their purchase price and their selling price, leveraging technology to minimize holding costs and maximize efficiency. However, what these companies failed to fully grasp were the nuances of the real estate market, the unpredictable nature of human behavior, and the potential for black swan events like global pandemics to upend even the most sophisticated algorithms. The real estate market, unlike the stock market or the world of e-commerce, is inherently local. It's influenced by a myriad of factors that are difficult, if not impossible, to fully capture in a spreadsheet or an algorithm. As the real estate tide began to turn, interest rates rose, and the economy showed signs of slowing, these tech-driven real estate companies found themselves in a precarious position. Their once valuable portfolios of properties were now liabilities, weighing down their balance sheets and spooking investors. The very speed and efficiency that had fueled their rise now became their Achilles heel. Unable to sell properties as quickly as they had acquired them, these companies were facing mounting holding costs, dwindling profit margins, and a growing inventory of homes they needed to offload. The result? A buyer's market is emerging, particularly in areas where these companies made significant investments. Properties are being listed at below market prices as these companies prioritize liquidity over profit maximization. This presents a unique opportunity for savvy investors who understand the dynamics at play. By recognizing the motivations and constraints of these corporate sellers, investors can potentially acquire properties at attractive prices, capitalizing on the tech titans' real estate gamble gone awry. So how can investors identify and capitalize on these opportunities? First, it's essential to understand the mindset of these corporate sellers. They are not emotional homeowners attached to their properties. They are businesses looking to minimize losses and maximize liquidity. This means they are often more willing to negotiate on price, especially if it means a quick and clean sale. Investors who can move quickly, secure financing, and make competitive offers are well positioned to take advantage of these opportunities. Second, it's crucial to conduct thorough due diligence. While these companies may be eager to sell, it's essential to ensure that any property purchased is structurally sound in a desirable location and priced appropriately. Don't be blinded by the allure of a bargain. Finally, remember that knowledge is power. By staying informed about market trends, tracking the activities of these corporate sellers, and understanding the forces shaping the real estate landscape, investors can position themselves to make informed and profitable decisions. While the Airbnb exodus and the tech titans' real estate woes are significant developments, there's another, often overlooked factor at play in the current market: the shadow inventory. Imagine a submerged iceberg, its true size hidden beneath the surface. That's shadow inventory. It refers to properties that are not yet officially listed for sale, but are lurking just beneath the surface of the market, poised to emerge and potentially flood the market with inventory. This hidden dragon, if unleashed, could have significant implications for real estate prices and market dynamics. This shadow inventory comprises homes in various stages of pre-foreclosure, properties held by banks and lenders due to defaults or strategic decisions, and homes owned by individuals or institutions facing financial distress who haven't yet listed their properties for sale. The reasons behind this shadow inventory are complex and multifaceted. They include the lingering economic impact of the pandemic, rising interest rates that have made mortgages less affordable, and job losses or income reductions that have made it difficult for some homeowners to keep up with their housing payments. Foreclosures are the dark underbelly of the real estate market. They represent the failure of homeowners to meet their mortgage obligations, leading to the forced sale of their properties by lenders. While foreclosures can be devastating for those who experience them, they can also create opportunities for savvy investors. As interest rates rise and the economy remains uncertain, the specter of foreclosures looms larger. Homeowners who stretch their finances to qualify for mortgages during the era of historically low interest rates may find themselves struggling to keep up with their payments as their adjustable rate mortgages reset at higher rates. Additionally, job losses, unexpected medical expenses, or other financial setbacks can push homeowners to the brink of foreclosure. These factors, combined with the potential for a recession, create a breeding ground for an increase in distressed properties entering the market. This is where the opportunity for savvy investors lies. By understanding the foreclosure process, identifying properties in pre-foreclosure, and knowing how to navigate the complexities of these transactions, investors can acquire properties at significant discounts to market value. Before a property enters foreclosure, lenders often work with struggling homeowners to try to find alternative solutions. One such solution is a loan modification, which involves changing the terms of the existing mortgage to make it more affordable for the borrower. Loan modifications can take various forms, such as reducing the interest rate, extending the loan term, or even forgiving a portion of the principal balance. The goal is to help the homeowner avoid foreclosure while minimizing the lender's losses. While loan modifications can be a lifeline for homeowners facing financial hardship, they don't always work as intended. Some homeowners may find temporary relief only to struggle again later, while others may not qualify for a modification that sufficiently addresses their financial needs. For investors, understanding the role of loan modifications is crucial. It's essential to know whether a property you're considering has undergone a modification and to assess the long-term viability of the homeowner's financial situation. Investing in foreclosures and short sales can be lucrative, but it's not for the faint of heart. It requires a deep understanding of the process and a tolerance for risk. Seek professional guidance from experienced real estate attorneys and agents. Foreclosure laws vary by state, so understand the specific regulations. Work with a local real estate agent who specializes in foreclosures. Short sales can be an excellent opportunity for investors. However, they often involve a lengthy approval process. Remember, knowledge is your best defense. In the world of real estate, not all properties are created equal. Some of the most desirable listings never even make it to the multiple listing service, or MLS. These off-market properties, often referred to as pocket listings, represent a hidden segment of the market where savvy investors can uncover hidden gems. Some sellers may prefer to keep their real estate transactions private, avoiding the public exposure that comes with listing their property on the MLS. For investors, gaining access to pocket listings requires cultivating relationships with real estate agents, brokers, and other industry insiders. These connections can provide access to off-market properties before they become widely known, giving investors a competitive edge. The off-market real estate arena operates in the shadows, away from the glare of the MLS. It's a realm where deals are often struck through whispers and handshakes based on relationships, trust, and a shared understanding of value. For investors seeking unique properties, below market prices, or a more discreet buying experience, the off-market can be a goldmine. It demands a proactive approach, a willingness to network, and a keen understanding of the local market. One of the most powerful ways to tap into the off-market is by building relationships with real estate agents who have a deep understanding of their local markets. These agents often hear about off-market properties through their contacts before they become widely known. The key is to be proactive, build relationships, and position yourself as a serious and qualified buyer. In real estate, your network is your net worth. Networking is not about schmoozing or selling yourself. It's about building genuine relationships with people who can help you achieve your investment goals. Start by connecting with local real estate agents, brokers, and investors. Attend industry events, join real estate investment clubs, and participate in online forums and social media groups. Be genuinely interested in what others are doing, offer your insights and expertise, and build relationships based on trust and mutual benefit. Remember, networking is a two-way street. By attending industry events and engaging in meaningful conversations, you'll gradually build a network of trusted contacts who can provide valuable insights and potential leads. Real estate is a people business. While technology has changed how properties are marketed and transactions are conducted, building relationships remains paramount. The strongest connections are often forged through shared experiences, mutual respect, and a genuine desire to help others succeed. When you approach networking with a mindset of building relationships rather than simply collecting business cards, you create a foundation for long-term success. Be authentic, be helpful, and be genuinely interested in the people you meet. By nurturing your network and providing value to others, you create a powerful ecosystem of support that can enhance your investment journey. Negotiation is an art form, a delicate dance between asserting your interests and finding common ground with the other party. In real estate, mastering the art of negotiation can mean the difference between securing a great deal and overpaying for a property. Effective negotiation requires preparation, strategy, and a deep understanding of human psychology. Before entering any negotiation, thoroughly research the property, the market, and the seller's motivations. Identify your walkaway point, the price beyond which you're unwilling to go, and be prepared to walk away if necessary. Focus on building rapport, finding areas of agreement, and creating win-win solutions. By mastering the art of negotiation, you empower yourself to secure favorable terms and maximize your returns. In the world of real estate, the adage caveat emptor, let the buyer beware, rings especially true. Due diligence, the process of thoroughly investigating a property before purchasing it, is your shield against costly mistakes and unforeseen problems. Due diligence encompasses various aspects, including reviewing the property's title report, inspecting the physical condition of the property, and evaluating the neighborhood and local market conditions. Hire qualified professionals, such as real estate attorneys and inspectors, to conduct thorough assessments and provide unbiased opinions. Review all documents carefully, ask questions, and don't be afraid to walk away from a deal if you have any doubts or concerns. By conducting thorough due diligence, you mitigate risks and protect your investment. We've talked about shadow inventory, those properties lurking beneath the surface, invisible to the average home buyer, but poised to make a splash. The question is, when will this pressure cooker explode? No one knows for sure when or how this shadow inventory will hit the market. But here's what we do know. The longer these properties remain submerged, the greater the potential impact on the market. Homeowners facing financial hardship, lenders holding on to non-performing loans, and institutions with portfolios of distressed properties are all sitting on a ticking time bomb. When they decide to release these properties, it could create a surge of inventory, potentially driving down prices and creating opportunities for savvy investors. However, this potential influx of inventory also presents challenges. It could create downward pressure on prices, making it more difficult for existing homeowners to sell their properties. During the 2008 crash, foreclosures were like a tsunami, wiping out communities and leaving financial devastation in their wake. But is history destined to repeat itself? While some experts predict a new wave of foreclosures, the situation today is different. Lenders have learned from the mistakes of the past and are generally more willing to work with struggling homeowners to find alternatives to foreclosure. Government programs, loan modifications, and a more cautious lending environment have helped to stave off a full-blown foreclosure crisis. However, the risk is not entirely eliminated. As interest rates rise and the economy remains uncertain, some homeowners may still find themselves unable to keep up with their mortgage payments. For investors, the key is to stay informed, track foreclosure trends in your target markets, and be prepared to move quickly when opportunities arise. When homeowners default on their mortgages, their loans become distressed debt. These non-performing loans, often bundled together and sold off by lenders, can represent a unique investment opportunity for those willing to navigate the complexities of this specialized market. Investing in distressed debt is not for the faint of heart. It requires a deep understanding of the legal and financial complexities involved, as well as a tolerance for risk. By purchasing distressed debt at a discount, investors can potentially acquire properties at below market value or profit from negotiating settlements with borrowers. However, this strategy requires careful due diligence, legal expertise, and a clear understanding of the foreclosure process in the relevant jurisdiction. Remember, investing in distressed debt is not a passive activity. Non-performing loans, those in danger of defaulting, are like ticking time bombs in the financial system. For banks and other lenders, they represent a drain on resources and a potential threat to their bottom line. For savvy investors, however, they can be a source of significant profit. The world of non-performing loans is complex and opaque, often shrouded in legal jargon and financial intricacies. With the right knowledge and guidance, you can navigate this market and unlock its hidden potential. The key is to understand the different types of non-performing loans, the stages of delinquency, and the various strategies for profiting from these investments. Remember, investing in non-performing loans is not a get-rich-quick scheme. Imagine this: a homeowner is underwater on their mortgage, owing more than the property is worth. They're facing foreclosure, but desperate to avoid the financial and emotional devastation it would bring. This is where a short sale comes in. A short sale is a transaction where the lender agrees to accept a sale price that's less than the outstanding mortgage balance. For the homeowner, a short sale provides a way to exit a difficult financial situation without the stigma and long-term credit damage of a foreclosure. For the investor, it's an opportunity to acquire a property at a significant discount. However, short sales can be complex and time-consuming. Negotiating with lenders is not for the timid. It requires a delicate balance of firmness and diplomacy, a willingness to stand your ground while maintaining a professional and respectful demeanor. When approaching a lender about a short sale or other distressed property dealings, it's crucial to be prepared. Gather all relevant documentation such as the property's appraisal, the homeowner's financial information, and your own investment proposal. Be realistic in your offer, but don't be afraid to negotiate. Lenders are often more willing to negotiate with investors who demonstrate a clear understanding of the market, the property, and the lender's motivations. Remember, time is often of the essence in these situations. Investing in distressed real estate is not a solo sport. To succeed in this specialized niche, you need a team of experienced professionals who can guide you through the legal, financial, and logistical complexities. Your power team should include a real estate attorney specializing in distressed property transactions, an experienced real estate agent with a proven track record in short sales and foreclosures, and a savvy accountant who understands the tax implications of these investments. These professionals can provide invaluable advice and help you navigate the complexities of the legal and financial landscape. Don't underestimate the importance of building a strong team. Real estate transactions, especially those involving distressed properties, are fraught with legal and financial complexities. Trying to navigate these complexities on your own is like performing surgery on yourself, not advisable. That's why having the right professionals in your team is crucial. A seasoned real estate attorney can review contracts, ensure you're protected from liability, and guide you through the intricacies of foreclosure law, short sale negotiations, and other legal hurdles. Equally important is a sharp accountant who understands the tax implications of real estate investing. By seeking expert advice, you're protecting your interests and setting yourself up for long-term success. We've covered a lot of ground, from the Airbnb exodus and the tech titans' real estate woes to the shadow inventory lurking beneath the surface and the complexities of distressed debt. Now, it's time to put it all together and chart your course to real estate riches. Remember, a market crash is not the end of the world. It's a time for opportunity. While others panic and retreat, savvy investors see the potential for profit amidst the chaos. But success requires more than just luck. It demands knowledge, preparation, and a willingness to take calculated risks. Learn the fundamentals of real estate investing, understand the forces shaping the market, and identify your investment goals and risk tolerance. Next, build your power team, assemble your resources, and be prepared to act decisively when opportunities arise. Let's face it, everyone loves a good deal. The thrill of getting something for less than its perceived value is deeply ingrained in our DNA. In the world of real estate, discounted properties are the holy grail, the elusive treasures that can turn ordinary investors into real estate moguls. But finding these diamonds in the rough requires more than just luck. It demands a keen understanding of market cycles, a nose for opportunity, and a willingness to venture beyond the well-trodden paths of traditional real estate listings. Discounted properties come in all shapes and sizes. The key is to know where to look, how to identify a good deal, and how to act decisively when opportunity knocks. The most sought-after properties, those with the potential for the highest returns, rarely hit the open market. They're like whispered secrets passed from one savvy investor to another, hidden from the prying eyes of the general public. These are the off-market deals, the hidden gems that can make or break a real estate investor's career. But how do you uncover these elusive treasures? It's not as simple as browsing online listings or attending open houses. Finding off-market deals requires a proactive approach, a willingness to network, and a deep understanding of the local market. One of the most effective strategies is to build relationships with real estate agents who have their fingers on the pulse of the local market. These agents often hear about properties before they're officially listed, giving you a head start on the competition. Attending industry events, joining real estate investment clubs, and connecting with other investors can also provide valuable leads on off-market deals. Remember, knowledge is power, and in the world of real estate, information is currency. In the world of real estate, your network is your net worth. The more people you know, the more access you have to information, opportunities, and deals that never see the light of day. But it's not just about collecting business cards. It's about building genuine relationships based on trust, mutual respect, and a shared passion for real estate. Think of your network as a web with you at the center. Each connection you make, each relationship you nurture, strengthens that web, expanding your reach and influence within the real estate community. Building a network takes time and effort, but the rewards are well worth it. Start by attending industry events, joining real estate investment clubs, and connecting with other investors online and offline. Be genuinely interested in what others are doing, offer your insights and expertise, and be willing to help others succeed. Remember, networking is a two-way street, and the more you give, the more you'll receive in return. Networking is not about schmoozing or self-promotion. It's about building authentic connections, listening more than you speak, and adding value to every interaction. In real estate, the most valuable information is often shared discreetly through whispers and subtle cues, not through loud pronouncements or flashy presentations. Mastering the art of the whisper requires a delicate touch, a genuine interest in others, and a willingness to listen attentively. When you engage with people authentically, asking thoughtful questions and demonstrating a sincere desire to learn, you create an environment of trust and openness. Remember, people are drawn to those who show genuine interest in them. By focusing on building relationships rather than simply collecting contacts, you create a foundation for long-term success in the real estate industry. As you build your network, focus on quality over quantity. It's better to have a handful of trusted contacts who can provide valuable insights and opportunities than a Rolodex full of names you barely know. In the world of real estate, due diligence is your armor, your shield against costly mistakes and unforeseen problems. It's the process of thoroughly investigating a property before you buy it, leaving no stone unturned, no question unanswered. Think of due diligence as a detective investigating a crime scene. Your job is to gather all the evidence, analyze the facts, and determine whether the investment makes sense. Don't be afraid to ask tough questions, dig deep for information, and walk away if you have any doubts. Due diligence encompasses various aspects, including reviewing title reports, inspecting the property, evaluating the neighborhood, and analyzing the financial viability of the investment. It's a complex process, but it's essential for protecting your investment and ensuring your long-term success. Remember, in real estate, knowledge is power, and due diligence is your best defense against costly mistakes. Don't cut corners. Take the time to do your homework, and you'll be rewarded with greater peace of mind and a higher probability of success. Title reports and property inspections are the cornerstones of due diligence, providing crucial insights into the legal and physical condition of a property. Understanding these reports is essential for making informed investment decisions and avoiding costly surprises down the road. A title report is like a property's history book, revealing any liens, easements, or other encumbrances that could affect your ownership rights. It's crucial to have a real estate attorney review the title report to ensure a clear title and protect your interests. A property inspection is like a physical exam, revealing any structural issues, plumbing problems, electrical hazards, or other defects that could require costly repairs. Hiring a qualified inspector is essential for identifying potential problems and negotiating repairs with the seller. Remember, title reports and property inspections are not just formalities. They're essential tools for protecting your investment and ensuring you're making a sound financial decision. Leverage, the strategic use of debt to finance an investment, is a powerful tool that can amplify your returns in real estate. By using other people's money to acquire assets, you can control larger investments and potentially generate higher profits. Think of leverage as a magnifying glass. Just as a magnifying glass can intensify the sun's rays, leverage can magnify both your profits and your losses. It's a double-edged sword that requires careful consideration and a clear understanding of the risks involved. When used wisely, leverage can be a powerful wealth-building tool. It allows you to diversify your investments, acquire more properties, and potentially generate higher cash flow and appreciation. However, it's essential to remember that leverage also increases your risk. If the value of your investment declines, your losses will be magnified. It's crucial to have a solid understanding of debt management and to use leverage responsibly. Securing financing is often the most challenging aspect of real estate investing. Navigating the lending landscape can feel like navigating a minefield. With the right knowledge and preparation, you can secure the financing you need. Understand the different types of loans available, compare options, and choose the best fit for your financial situation. The real estate market is like a roller coaster with its ups and downs, twists and turns. Trying to time the market perfectly is a fool's errand. Instead, focus on developing a long-term strategy that can weather the inevitable market fluctuations. One of the keys to long-term success is diversification. Don't put all your eggs in one basket. Instead, spread your investments across different property types, neighborhoods, and price points. This will help to mitigate your risk and protect your portfolio from market volatility. Another key is patience. Real estate is a long-term game. Don't expect to get rich quick. Instead, focus on building a portfolio of quality assets that will generate consistent cash flow and appreciate over time. Remember, real estate investing is a marathon, not a sprint. By staying informed, adapting to changing market conditions, and focusing on the long term, you can ride the real estate roller coaster to success. We've journeyed through the turbulent waters of the real estate market, exploring the currents shaping this landscape. Just as the tides ebb and flow, so does the real estate market, presenting challenges and opportunities. The global pandemic shook the travel industry, leaving Airbnb investors grappling with market saturation. Tech titans like Opendoor and Zillow stumbled as their algorithms collided with market complexities. Amidst these waters, we've discovered hidden currents of opportunity. We've explored shadow inventory, properties waiting to be unearthed by savvy investors. Real estate investing is a marathon, requiring patience and adaptability. The struggles faced by Airbnb investors and tech-driven real estate companies are symptoms of a deeper shift. The days of easy money and rapid appreciation are fading. Rising interest rates and economic uncertainty have cooled the market. Buyers are more discerning, sellers face increased competition, bidding wars, and inflated prices are waning. This shift presents both challenges and opportunities. For those who adapt, it's a chance to acquire assets at better prices. Remember, the real estate market is cyclical. Like a submerged iceberg, shadow inventory represents a hidden force shaping the real estate market. These properties, not yet officially listed for sale, have the potential to flood the market, impacting prices and creating both opportunities and challenges for investors. The reasons behind the shadow inventory are complex and multifaceted. They include the lingering economic impact of the pandemic, rising interest rates that have made mortgages less affordable, and job losses or income reductions that have made it difficult for some homeowners to keep up with their housing payments. For savvy investors, shadow inventory presents a unique opportunity to acquire properties at below market prices. By networking with real estate agents, attending foreclosure auctions, and understanding the intricacies of distressed property transactions, you can potentially uncover hidden gems and capitalize on the market's inefficiencies. However, it's essential to approach shadow inventory with caution. These properties often come with baggage, such as deferred maintenance, title issues, or reluctant sellers. Thorough due diligence, legal expertise, and a clear understanding of the risks involved are paramount for success in this specialized niche. While the word crash evokes fear and uncertainty, remember that market downturns are a natural part of the economic cycle. Just as the phoenix rises from the ashes, savvy investors can emerge stronger and more prosperous. Shift your mindset from fear to opportunity. See it as a chance to acquire assets at favorable prices, refine your strategies, and position for long-term growth. Emotions run high, but remain calm, stick to your plan, and focus on fundamentals. The best decisions are made when others act irrationally. Embrace the crash, learn, and use it as a springboard to success. Now that we've explored the real estate market, it's time to create your action plan for success. Tailor your plan to your goals, risk tolerance, and financial situation. Step 1, define your goals. What do you hope to achieve? Step 2, educate yourself. Knowledge is power. Step 3, build your network, connect with professionals. Step 4, develop your strategy, determine your approach. Step 5, take action. The market rewards decisiveness. Start small, learn, and scale as you gain confidence. The real estate market is constantly evolving, presenting both challenges and opportunities. Market crashes create opportunities for savvy investors to acquire assets at discounted prices. Embrace market crashes as catalysts for growth and learning. Approach the market with a long-term perspective and a commitment to education. Your journey to financial freedom starts with a single step. Take that step today.